Well, this is Current Yield, Grant's Interest Rate Observer of the Year. I am Jim Grant, and with me, as always, is the great Deputy Editor of Grant's, Evan Lorenz. Welcome, Evan.
Good afternoon, Jim.
I say welcome as if you didn't work here. You worked here for 15 years. I'm saying welcome. Okay.
Well, it's nice to still get a welcome occasionally.
I can tell you guys keep things light here.
And Harrison Wadill is our stand-in technologist, sound engineer. Thank you, Harrison. And with us today, the fellow whose voice you just heard is Michael Haynes, about whom and from whom we'll be hearing a lot in the next half hour, 45 minutes. Nobody says nothing, and we have to stop, but I think that will not be the problem when the topic is private credit. Hey, Evan, was I misinformed, or this very morning, did Donald Trump not kind of spitball the idea of himself becoming the Fed chairman?
He did indeed. He said, I can appoint myself, can't I? Or something along those lines.
Yeah, it wouldn't be a bad idea, I suppose. So I would, before we get into a serious matter here, I want to tell a story that actually is a seasonal story, a sartorial story, and one that bears a little bit on the march of human progress. You ready?
Mm-hmm.
Yep. Okay, I'm wearing, what do you think of my seersucker suit?
I think it's quite nice, quite dashing.
Elegant, right? Michael, you on board?
I agree. Right. It's lovely.
Harrison, good, right? These guys work for me. What are they going to say? Okay, so I want to tell you a story about John Whitehead, who was the longtime head of Goldman Sachs, and his first day at work. John Whitehead graduated from college around 1941, kind of a fateful year in which to get out of school and into the workforce. His workforce was the United States Navy, and he was commissioned a ensign and came to be a landing craft boat officer. And 2 points on his naval resume was D-Day, 1944, and Iwo Jima, 1945. All right, so he gets out of the service, and he gets a job at Goldman Sachs. And he was detailed to the kind of the bullpen for investment banking research, then a very small department. And the department was situated in a kind of a reconditioned, or not so reconditioned, squash court. On Wall Street. Wall Street was not the shiny place it was for a while, and actually no longer is, but it became shiny. It was not then, in 1946, at all shiny. So this workplace was in the cellar of the Goldman Sachs enterprise, and it had these windows. When you use a pole to pull them down, the kind of like you had in reform school. Right, okay. And so he figured he should dress comfortably the first day of work. So went out to like Brooks Brothers and got himself a suit like this. I'm coming around to the point. This is a seersucker suit of some elegance, no? Mm-hmm. All right. So John Whitehead, aged probably 23 or 24, but ever so much older in experience in the world, shows up at the Goldman Sachs reception area waiting for his elevator going down. And he encounters a senior partner. It might have been Sidney Weinberg himself, the eminent head of Goldman Sachs for decade upon decade. Weinberg looks at him and says, son, do you work at Goldman Sachs? Yes, sir, it's my first day. Ah, very good. Here's what I want you to do. I want you to go home. I want you to take off those pajamas, and I want you to get some clothes on and come back to work at Goldman Sachs. So you can see the relevance of this, right? We got air conditioning now. We got shiny buildings. We got custom-made bullpens for the dweebs who do all the analysis, right? Everything's better, except debt, which is still with us. That's not inherently bad, but... So, Michael, tell us what you do for a living, please.
Sure. I'm a partner and the head of private credit at Beach Point Capital Management. This is a firm that I've been with since its founding in January 1st, 2009. So we were talking about how long ago that seemed. And yeah, it's been more than half my career at this point. Been through with that firm a period of growth where we went from a couple billion of assets under management, which at the time seemed like a lot, to today, 20 billion of assets under management, which seems like a little. So you can think about that, compare and contrast, and how the business has scaled.
A lot, even when you say it fast. Yeah. So I like to fill in some points of your resume, which you have modestly neglected. And one is you worked for a time as a treasurer and vice president of Sirius Satellite Radio.
I did. I was, by my recollection, the fifth employee of that company when it was nothing more than a bank account and a business plan and an FCC license.
All right. What Evan wants to ask you, and Harrison demands that I ask you, is do you get to pick hits for like 60s on 6?
I would have if we had anything broadcasting at the time, but we did not. So I did get to think about things like how on earth are we going to create the technology or raise enough money to launch a bunch of satellites and things like that.
Did it work? I've lost track.
Sirius is an incredibly profitable company now.
Okay, yeah.
I would say like all companies of that, business plans of that scope and scale, things didn't exactly go the way everyone imagined it at the beginning. However, today, I would say the product looks kind of like we envisioned it at that time.
Yeah, great. Okay, so also, finally, I see that you are on the board of advisors of the Tufts University Athletic Department, which usually relates in some way to some superior athletic achievement at your alma mater, which is Tufts. So tell us, but don't be modest. Tell us.
I have some achievements and some dubious honors. My achievements are I was a 4-year varsity soccer player at Tufts and had a pretty good career over my 4 years. I think I had more minutes on the field than any of my class. The dubious honor is over those 4 years, I scored exactly 0 goals. And I would say that was something of an accomplishment.
Well, that's soccer, right?
It is soccer. Also, I was a defender, but still, it took some amount of statistical anomaly to produce someone on the field that much who never scored a goal.
Well, actually, the Yankees are trying to work on that record. This was
right.
3 games without scoring. Anyway, so Michael, I know Evan has a lot better questions than I, but I want to ask you about branding. So you're in private credit, right?
I am.
How would that be if we called it private debt?
I would say no different.
No different? No. I would say that private credit is a euphemism that bamboozles some people into thinking that the essence of the thing, that is to the promise to pay eventually, is slightly more wholesome. No?
So I agree that there's some branding. I would say that also has some relationship to sort of how we've had to change our business over time, which I'm happy to get into now or later. But you're right. There's an aspect of branding and how we position ourselves that's different today than when Beach Point launched.
Getting over to the state of health of private credit, the IMF had a report recently out saying 40% of private equity portfolio companies reported negative free cash flow in 2024. And this is before Donald Trump imposed the wonderful tariffs in Liberation Day. So I'd love to ask you, what is the state of health of leverage finance today?
I think there's sort of the external data points that would tell you things are relatively healthy. And by those, we can look to just sort of spread. And we specialize in sub-investment grade credit markets. So generally, when I speak of things, I'm going to be thinking of things in the sub-investment grade market. Spreads are pretty tight. I mean, they would tell you that the market's relatively healthy and investors are generally positive on the outlook for sub-investment grade credit, which would be the high yield bond market and the syndicated bank loan market. So that's how bonds are being priced. If you look into sort of how the underlying credits or the underlying debt is performing, you might come to somewhat of a different view. And I'll give you some stats to frame it out. Couple basic credit stats, right? Leverage metrics, debt service coverage are two of the material ones. How well are companies able to service the debt load that you're referencing? And the answer to that is, on balance, not all that well. If you look at something like interest coverage, and right now I'll speak about the private credit market. Right now, depending on what stats you look at, 20 to 30% of the market's not covering debt service. I mean, that's a massive number, and that should be somewhat alarming to the sort of market overall.
What is a normal number? Because some private equity companies are growth companies, and as growth companies, they're investing to actually become larger companies, and they're not going to cover, interest expense, or they'll have negative free cash flow. What is like a normal number for not covering debt service?
I mean, if you went back, that number would be in like not more than 10%. So this is kind of multiples of what you'd historically see. And if you're to ask the major providers of credit, they would say, what do you mean? My entire portfolio should be covering debt service because we're underwriting things conservatively and so forth. And so that is a concerning number. More concerning is also the trajectory that's gone from, single digits 3 years ago to, what it is today. And so the trajectory of that is following the interest rate cycle, and that's not suggesting a very positive outcome.
What's interesting about that also is that here we have a level of unemployment that in times past would be considered full employment. That's a variable that definition is changes with political opinions and central bank modeling. But nonetheless, not a problem, capital P, in the jobs market now. And it coincides with an okay economy, or maybe a more than okay economy, as measured by the GDP growth, and with near record highs in various asset classes. So, for perspective, what might that number have been that didn't cover fixed charges out of cash flow? Say when you started, which was at the bottom of the credit cycle in January 2009, which, by the way, was a genius time to have started a credit firm.
Yeah, when I started, timing is everything, and so for the first couple of years, like if you started January 1st, 2009, everything you touched turned to gold for the first couple of years. So I'm sure I thought myself quite a clever investor, but I have survived now through a couple of different cycles. It's tough for me to recall exactly what that environment would have looked like. 2009 was obviously a tricky time, going through a period of dislocation. Nevertheless, if I had to guess, I would guess today's metrics are still substantially, more pessimistic than that, because at that time, rates were really low. And so companies were still able to take advantage of low financing costs as the Fed rapidly brought down rates. And so you might have had a poor sort of long-term trajectory, and you may have had a recession that impacted business, but the cost of your debt load was, sort of on a proportionate basis, probably more affordable than it is today. Just touching on your comment about employment, I agree. The economic backdrop, like the fundamental performance of companies, isn't bad today. So that's not what's causing stress. What's causing stress is the sub-investment grade credit market is largely dominated by leverage buyouts in the private equity industry. That industry, if you go back a couple of years, was paying, I would say, pretty ambitious multiples. They're paying in pretty ambitious multiples predicated on base interest rates that were, near zero or something pretty low compared to where they are today. And so they had debt levels and costs of debt in their models that just aren't sustainable in a world where we're looking at, a 4+% long-term interest rate.
One of our themes here at Grants is that where interest rates have been is almost as important as where interest rates are going in this particular cycle, because the legacy of 0% rates and the legacy of the projection of ZIRP into the indefinite future, thanks in part to the Fed, which allowed people to have that misconception in the front of their mind, that is informing or is determining it to some degree the credit performance now. So it's the past that matters as much as the future with respect to rates now.
I agree with that. I mean, mostly by reference to, just to step back. So the private equity industry, right? Sitting on $3 trillion of assets they can't sell for a profit. And so for now, they'll try and kick the can down the road and won't sell them. And a lot of that was because of the prices they paid embedded in an environment with low interest rates. So all of that is sort of bringing us to today's environment, which is too much debt, too high a price for that debt, a need to figure out how to extend their runways to figure out if there's some exit that will yield returns. And so, that's a tricky environment for the equity. For creditors, if you look at sort of reported default rates, all of these dynamics have not yielded some big spike in bankruptcies. On the other hand, like I mentioned, if you look at sort of the price of securities, that tell you things are healthy. If you look at credit metrics, maybe not. Same thing. If you look at default rates, would tell you, oh, okay, so like whatever, companies are managing through this period, no matter what Michael's saying about interest coverage. On the other hand, if you look at sort of out-of-court restructurings, you'd see a much higher sort of implicit default rate. And oftentimes those restructurings that are out of court are not exactly consensual. So if you've heard of the concept of liability management, that would be kind of a complexity in the market today.
It's a favorite concept of ours.
Yeah.
I love to talk about, we could have an entire different session just on that, favorite topic of mine too. And that construct has also changed our business in other ways as well.
That's actually something we've struggled with. So according to Lincoln International, the default rate on private loans, so not a high yield in general, but just private credit, rose to 2.9% at the end of the first quarter from 2.4% at the end of 2024. But they said that number is masked because a lot of troubled borrowers are going to payment in kind, so they're using PIK, and they're also doing liquidity management exchanges or amend, extend, or whatever you want to call them. If you were to say, just based off of what you're seeing and what it feels like, what is the distressed ratio in private credit?
If I were to think of a default rate that reflected more of a sort of inclusive of extensions where you're adding PIK interest and things like that, it's got to be in the high single digits. And that would be a historically somewhat pessimistic default rate. And so I'm including in that deals where maturity extensions have been entered into with PIK interest purely because sort of creditors are not interested in taking the keys or otherwise not enforcing on borrowers. And that would be high, and it'll go up from here.
So the long cycle that started after your firm started in 2009 had very, very low defaults, very, very low yield, and it seemed like you could put money to work without actually having much money at risk. And as a result, I have to imagine a lot of private credit firms, not yours, but didn't have a lot of money invested in workout teams. To what extent has kind of private credit's willingness to kind of, not your firm, but kick the can down the road because they just don't have the wherewithal to deal with, the volume of private problem credits that are here?
So there's two things happening in direct lending that are impacted by the dynamic you're describing. Thing one is keep in mind a lot of private credit providers still view the private equity industry as their customer. And as a consequence, there's a certain amount of leniency they want to provide those customers so that they come back for more product. And so there's an aspect of wanting to be more in partnership with borrowers than strictly to have a borrower-creditor relationship. So that's one dynamic that's causing private credit providers to want to be more sort of accommodating to their borrowers. The second is what you say. Look, Beach Point, we think carefully about wanting to have the world think of us as a solutions provider. So we want the world to think of us as whether you're needing capital in the public markets or needing capital in the private markets, we are willing to cross product types and rules of the road, and we'll come up with a package of capital to solve problems that's unique and tailored to whatever the company or borrower or entrepreneur or private equity firm is needing. And in that sense, we need people to think of us as a partner too. Having said that, as a part of our history in sub-investment grade credit across Beach Point, we've been through dozens, for each of the senior team, been through dozens of restructurings, sat on creditors committees. And so we have that built into our DNA. So when we're dealing with creditors who are borrowers who are going through issues, we're kind of comfortable in that environment. We've been through credit cycles. We know how to work things through. We have our own dedicated restructuring team when that's a part of the toolkit that we need to apply. And so those types of credit cycles are just kind of part of our general comfort in sub-investment grade credit, where we're confident how things will ride through. What I see in private credit in some of maybe the larger providers is they grew up more as sales organizations, right? They have 10, 20, 30, 50 salespeople who run around and knock on private equity firms' doors saying, hey, have I got a deal for you? You should really borrow from me instead of borrowing for anyone else. And the growth of that industry really hasn't seen a material credit cycle. And so a lot of those businesses that grew up just in that market just don't have the repetitions or muscle memory for how you behave when you don't have one company that's going through trouble. You might have 5 or 10 or 20 in your portfolio that you're all dealing with at the same time. And so for us, we view that, I would say marginally positively. I'm not sure the industry on the whole is really staffed to accommodate that. And it's not just like, have you hired enough people? It's, do you as a firm institutionally have a comfort knowing not every sub-investment grade credit is going to work out, not every private credit borrower is going to make it through the cycle, and you're going to have to be comfortable enough with the underlying business to sort of work through that.
Maybe the salesman could double as credit analysts.
in theory, but in many cases, the incentives for those salespeople are to originate, not to live with the outcomes. So it is a difference between firms that grew up sort of on the private credit origination side, where that's been what's been rewarding to them economically, and people who have grown up on the investment management side, where what you're looking for is outperformance versus your benchmarks and your peers, where you're measured in a different context.
Did you see the story, Evan and Roundtable? Did you see the story about Brookfield today, that it was pulling back from investing in private credit because it was overcrowded and the bids were much too aggressive? And this is from the same firm whose CEO about a week ago said within 25 years, private equity, private credit, private everything, not corporal or sergeant, private, is going to be the predominant asset class, and public securities will be the alts.
So I want to challenge that statement for a second, because I think that is not what I observe in the market. What I observe is it's not one thing's going to be bigger than the other. It's that you're not going to be able to distinguish between the two. And I'll give you some examples of that. And this is part of Beach Point's business model. Like, we have as great a capacity in what today is public markets versus private markets. And we bring public credits into the private markets. We bring private credits into the public markets when that's appropriate. And so our ability to live at the intersection of the two is kind of a part of our sort of competitive differentiation. And as a result of that, our sort of point of view is that increasingly you're not going to be able to tell the difference. I'll give you an example. We own debt of a company it's a consumer products company. It's private equity sponsored, good business. Company, let's say it's give or take worth $500 million. They have a couple $100 million of debt. Originally, their loan was a quote unquote broadly syndicated bank loan, but I say quote unquote because it really has 5 lenders. And if you want to buy some of it, you call the other 4. And guess what? If you want to sell some of it, also you call the other 4. I don't know, is that a public loan or is that a private loan? While we think about that, I'll go to another circumstance. This is a software company where they had syndicated loans, first lien and second lien, multi-billion-dollar capital structure. And that company chose to go to the private credit route, where in their private credit loan, there were probably 20 or 30 different market participants. And it would be far easier to buy or sell a piece of that than it would be to buy or sell a piece of the first example I gave you. Increasingly, we're seeing the same thing. We're seeing, borrowers saying, well, I want to go the private credit route. They just mean they don't want to deal with an investment banker, and they'd rather talk to the people providing the capital directly than they would go through an exhaustive marketing process. And why should they bother? The 5 lead lenders know what they want to do anyway, and they know how to price it. And so it's just more of an ease of use. But I don't really think in 5 or 10 years' time, there's going to be that same level of distinction. It's just not going to matter. And when you look at market participants, the same thing is happening. Our peers who grew up in the investment management side, largely in the public markets, are increasingly active in things that today would be regarded as private. And firms that grew on the private side are hiring capital markets groups in the same thing. And so I think that distinction, all respect to Brookfield, I think that distinction isn't observing what's actually happening on a transactional basis today.
All right. I would like to say a word on behalf of our sponsor. You know who that might be? It's Grant's Interest Rate Observer. We have been holding a fall conference since almost since the time we started 42 years ago, and we're having one this fall. And it's September 1st, September 30th. Harrison's staring at me. Please get my facts straight. September 30th, a Tuesday. And it's at the Plaza Hotel as usual, and there's an early bird pricing thing. You can go to our website and look at that. But the speakers are merely stellar, including, I'm going to take them in alphabetical order until I won't. John Hughes, who is a premier stock picker. Victor Kolza of Strategic Value Partners. Nate Kopikar, who is a surviving short seller, which, by the way, is like getting a Nobel Prize on Wall Street. There's the great gold guy, Pierre Lassonde, and John Lewinson of Diameter Capital Partners, Terrence McLean, who was an insurance guy of a very interesting one, and David S.H. Rosenthal. The S.H. is important because he was at Stanford, and he tells me that there are more than one, in fact, many more than one David Rosenthals, but David was a number 4 hire at NVIDIA who has got some opinions on crypto. They're most interesting. And finally, or semi-finally, we're still waiting for some names, is Kevin Warsh. Now, the thing to know about a grants conference is that if somebody is meant to be, rumored to be, a Treasury Secretary or a Fed Chairman, that person will have spoken at the grants conference. Scott Bessent spoke last fall. And what happened to him, Michael, do you recall?
I do. It seems to me he got kind of an important job.
Yeah. Yeah. So I'm not laying down any bets on Kevin Warsh, but he's going to be the next Fed chairman. So anyway, it's important that you come to this conference. It's always fun. It's always stimulating. We have people who want to help you come away thinking, wow, that was valuable. And indeed, it will be. So please reserve your seat today, as the ad says right in front of me. So, Evan, you...
Michael, amongst the things that Beach Point does is investing in distressed credits. You pointed out that if you look at the companies that are borrowing in the high yield market, there's quite a number that are distressed. But if you look at the default rate, it's actually quite low relative to history. What is kind of the opportunity set you see kind of in distressed credits today, and how does it compare to prior times?
Yeah, so today's sort of distressed credit market is largely driven by what we were referring to before as LME, or liability management exercises. And so it's important to distinguish sort of the drivers of prior cycles and this one. The drivers of prior cycles tended to be sort of fundamental, right? Like there was some big dislocation, some limited access to capital that was causing companies to not be able to refinance, or otherwise going through fundamental downturn that were causing default rates to spike. Today's distressed opportunity set is a self-inflicted wound by the capital markets directly. And that self-infliction was going back a couple of years, in particular to sort of the 21 and 22 timeframe, but even before that, the provision of capital in high yield or syndicated bank loans on the basis of docs that there's all this discussion about and covenant light loans. So there's no financial covenant, so you get sort of early warnings to companies' downturns. This is not that, right? Like this is other flexibilities in documents that allow borrowers to strip collateral out of your pool and therefore to exert leverage on you to either exchange into discounted paper.
Leverage loans,
right? Like, so it gives them the flexibility not just to do things that help their business, but to exert pressure on you as a creditor to do things that are implicitly causing you to involuntarily go along with the restructuring of the balance sheet.
Now, is what we are trying to say here, Michael, that there's a predatory strain in the credit markets that is most unbecoming, and it will somehow redound to the detriment of lenders and borrowers alike? Or is it too moralistic?
Already happened. I mean, I don't want to put it as moralistic because in a sense, like as an institutional provider of capital, you're supposed to read the documents and you're supposed to analyze what it is you have and therefore where are the risks and rewards of that document. And so to me,
nobody reads the document.
here's a statement. I believe for the large concentrated Beach Point positions, and in theory, most every position at Beach Point, someone on the investment team has gone through every document at our firm. So it's that attention to legal analysis. When you're a creditor, like, let's face it, you don't own anything, right? You own a stack of paper that gives you your rights and preferences and entitlements. You own a contract. You don't really own a stake in anything directly. And so we put an awful lot of time into analyzing and understanding and reading those documents. I'm not sure that's a commonality to the entire market. And so the outcome of this leverage that the capital markets have provided to borrowers, in this case, mostly large private equity firms, is an ability to be coerced into providing flexibility and sort of involuntary restructurings that, creditors are unhappy with. And when we talked about default rates, you saw it. We talked about low default rates, but if you include what we're calling distressed exchanges, default rates go up to a number that's, not very becoming, to use your term. And that's what's kind of going on there. That has the impact in the markets of really only advantaging the large-scaled providers. And that is because at least as a large participant in a credit stack, if you're one of the top couple lenders, you know that you'll be the ones engaging directly with those borrowers. And those documents oftentimes even give the largest creditors the opportunity to take value for themselves at the expense of all the rest of the creditors who are not sitting in the room.
Right. That's the whole point of a liability management exercise. No, it's to steal from others.
It's on the one hand, transactions that benefit owners of businesses at the expense of their creditors. And secondarily, even within that dynamic, to allow the largest, most influential creditors to benefit at every other creditor's expenses. So there's sort of like a cascading effect of lousy docs. I got to tell you, like it really has changed our business. One, to make scale a competitive differentiation. So that's like BeachPoint as a firm, we're way more concentrated in what we hold, because if we're not likely to be a top 1 or 2 or 3 or 5 creditor, we're probably not going to get involved in a situation. And so it's I don't say constraining, I'll say it's focusing and concentrating us on our highest conviction ideas where we know we're scaled enough to be very, very influential within credit stacks. So that's one. The second thing that's happened is when we started BeachPoint, you could sort of quote unquote trade the market, right? Like you could see a bond and think that it was cheap and buy it at, 80 or 85 cents. And you could buy 5 or 10 million and maybe you couldn't buy a lot of it, but who cared? And if it appreciated, you'd sell it. And maybe if it traded back down, you'd buy it again. And so we were quite active traders in the market, but you can only really do that in small scale. Today, our trading activity is reduced because we won't even buy a little piece if we don't think that's going to wind up with the level of conviction that we have that we were going to become one of the top creditors, even if we're going to need to aggregate that over time.
How is this going to play out come the next liquidation event? Where are the bids going to be for these little pieces that you could get, you'd find snatched away from you by some clever lawyer in a court proceeding?
Yeah, I mean, for sure, I think the market has become sort of less liquid in aggregate than it has been. And so that too, a little bit benefits the largest scaled providers in the sense of like our capital is generally very sticky and it's very patient. And so we don't really care that much about marks to market. And so if there are smaller creditors that are forced to sort of liquidate their holdings or don't have conviction or just want to get out, they're not going to get the same price they used to get for that same trade. And so that definitely is an advantage for us. In particular, you can see some of those dynamics in the CLO market. So CLOs, so you have a broadly syndicated loan. When it's issued, it might go to 10 or 20 or 30 or 40 different CLOs, right? A big participant in syndicated bank loans for new issue. Let's take a circumstance where those are light docs. Now you have a private equity fund who owns a business, reads their covenants, realizes they can exert pressure on creditors to give them an extension that creditors maybe shouldn't really provide, economically speaking. And so they'll introduce the idea publicly of wanting to engage in discussions with lenders. Maybe they'll hire a restructuring advisor, which is their signal that, hey, we're going to come with an ask. And maybe they'll get downgraded. And you will then see CLOs in effect become almost forced sellers of assets. And the buyers of those are firms like BeachPoint. And so, who are not sensitive to ratings and who are interested in aggregating, sort of larger stakes. And so you have smaller holders in the form of CLOs who in those circumstances wind up having to trade smaller pieces and not getting very good execution. And so that's one specific market context that plays out today.
Do you employ somebody who is an expert in game theory? Because it sounds like so much of when you're buying a credit right now, you not only have to look into the docs, but you have to look into the means and motives of the other people who are holding that credit, which would mean that if they're able to gather a majority of creditors, just 51%, they can extract so much value if anything goes wrong that even if you're buying at 85 cents on the dollar, maybe, 40 cents would have been the right price.
Since our investment team is at this point over 60 people, I'd say we have 60 game theorists at least. It's an active part of everything we do, scrutinizing in public circumstances who the other holders are. We have deep relationships within the buy-side community directly, and so we're always carefully considering who those are, making sure we know what their thoughts are on a particular circumstance. Speaking with the company directly gives you a lot of color on what direction we think they're going fundamentally, speaking with the private equity sponsors. And like I said, oftentimes it's we're already one of the top creditors. And for most of our large holdings, that would be the case. And in that case, it's as much people calling us trying to figure out what we're going to do as anything else. Our approach to the world, generally speaking, we prefer not to extract value from other creditors. In Beach Point's sort of philosophy, what goes around comes around. And so we probably prefer to negotiate with the company and bring the other creditors in the stack with us along as a function of being thought of as a sort of constructive market participant. So our negotiations tend to be more with borrowers than they are sort of figuring out how to, grab a couple nickels from other creditors. Nevertheless, that's a dynamic that exists in the market. There's some people who are more aggressive about that. And, preferably, we have not been on the other side of any of those circumstances so far, sort of out of the lead group in a way that has hurt us economically. And I hope we maintain what's been more or less a perfect track record in doing that. In the names where we got involved in sort of out-of-court restructurings, generally speaking, those have worked out pretty well for us. But, it's a new aspect in the market, and we're all going to have to get comfortable that that's kind of here to stay. By the way, today's new issues are partially more constraining, but I would say not fully constraining against those same dynamics. So you'd say, wow, haven't capital markets learned their lesson? And the answer is...
That's where we have cycles. Hey, there's a lot of interest in bringing the dear public, into the private credit market as investors. What do you say to that? What other opportunities that the public might, in fact, embrace profitably? Or is this another one of the occasions to do the opposite of whatever Wall Street invites you to do?
Let me see. What I think is all investors, our investors happen to be institutional, but I'll apply this to the retail markets as well. It's all about making sure you're getting what it is you've been marketed. And so private assets, by their nature, are longer-term holdings, which through credit cycles should have a reasonably attractive return profile for the risk that is being taken on those investors' behalf, whether institutional or retail. So to the extent they're being marketed with sort of the right disclaimers and characteristics, I don't have any problem with retail investors getting involved in private assets. I do worry more about the underlying structures, which is to say fund structures that in theory offer investors quarterly liquidity for an asset class that by its nature is illiquid and therefore, could be challenging to deliver hard quarterly liquidity in a risk-off environment. And so I don't want to say that I think that by nature those are unhealthy products or inappropriate products. I do want to say I hope they're sort of regulators require appropriate marketing of those products and make sure that those investors have the right expectation for how they should think about owning those in their portfolios. Now, if you think about a long-term retirement account, particularly for people in their 30s and 40s, they should have 10, 20, 30-year time horizons, at least for some portion of their capital. So we can step back and say, okay, so private illiquid assets might be plenty good application for that type of profile. Certainly not for all of a retirement account's assets, but certainly for some portion of it. The issue is, if an investor is thinking, oh, great, I can just, next quarter call up and get my money back. My private client advisor told me so. And then they do so. And what they realize is they're getting in line behind a lot of the other folks who also want liquidity at the same time. That would be less healthy. And like we've seen some evidence of that in the global financial crisis, that, sort of assets and liability mismatches created some problems in the types of products that were applicable in that cycle. So I don't have any problem with the philosophy behind it. I do have some concerns with the application and with investor expectations. And on the other hand, I don't, private assets on the whole, particularly private credit, I think do, as we were talking about the comments from Brookfield, have a long-term home and offer value to the markets that banks can't provide, that investment banks can't provide, that high-yield mutual funds can't provide, and CLOs can't provide, and so forth. So there's a viable home long-term. for private credit. I just think it needs to be applied in a healthy way.
Can I ask just you to speculate on one thing, the shape and kind of the duration of the next credit cycle. So you started your firm in 2009, and Marty Fritzen told us in 2009 the high yield default rate then hit an all-time high, but within 12 months later it fell below its long-term average. That was very short because the Fed took rates to zero. Perversely, the high yield default rate remained elevated for multiple years after the dot-com bust because so many telecom companies had laid down dark fiber and went bust. How do you see the next credit cycle playing out in terms of duration and kind of, I guess, amplitude?
Oh, yeah. Look, I mean, if I could predict the timing of the next credit
You'd be
cycle, or
working-
if any of us could predict the timing.
No, if you could predict the timing and amplitude of the next credit cycle, you'd be working at grants.
Or I'd launch a macro fund, maybe.
But I mean, you
however-
talked about some things like the fact that there's
listen,
LMEs, there's room in credit docs, so there's much more leeway in terms of the borrowers to do stuff, which
It's true, and I don't mind speculating. I think that our way of thinking about it is, on the one hand, information has provided a more rapid feedback loop to credit cycles. On the other, we're of the opinion that there were particular dynamics that gave rise to more rapid recoveries in the two prior cycles. It's called the global financial crisis and the pandemic, that are probably less applicable today. And those two were generally synchronized monetary policy. And if the presumption was you could bring rates down to zero, and that's what basically we saw in both those cycles, that created a massive flood of capital into assets that offered any sort of income premium yield. And so, at least in our markets, was a big driver of that. And I'm not sure central bankers, at least rational central bankers today, have anywhere near that level of tool available to them, particularly given the sort of increase in inflation sensitivity. And so we expect more of a kind of a grinded out cycle. Whether that cycle would therefore be, a year or 2 years or 3 years, I think is a little more difficult to speculate on. But I don't think, as a result of more constrained monetary policy, it's likely that we would see the same like rapid retraction in spreads that we saw in the prior cycles. So our way of approaching that would be to enter the next cycle with a fair degree of patience. That sort of served us well historically. And generally in those cycles, the second reaction that we have is to up-tier the quality of our portfolio, which is to say, term or premium return today, we might be dealing with middle market companies. We might be dealing with companies that are, good businesses, but we'd call them sort of, type B businesses or quality B businesses rather than quality A businesses. And when you have the opportunity in a big risk off cycle and everything's trading down, we would tend to, go up in scale, meaning get into sort of larger cap companies and go only into market leaders with contractual cash flows and other very protective characteristics. And not only are those lower risk, but they also tend to be the fastest to recover. So that's how we create sort of increasing levels of convexity in our portfolio, particularly when we're predicting a sort of longer credit cycle than maybe the ones we've experienced the last two times.
Michael, thank you.
Thank you.
My money's on you, man.
Appreciate it. So nice to have you.
Yeah.
It's been a long, historic run for grants, and I've been an avid reader, so appreciate the chance to come.
Thank you. And thank you, Harrison, for filling in. And Evan, good to see you as always. And ladies and gentlemen, thank you for listening. I expect we'll see almost all of you at the September 30th Grants Fall Conference at the Plaza Hotel. And until then, nice to talk to you.